An option contract is an agreement between buyer and seller over an agreed upon number of shares at a price agreed upon today for delivery at a set time in the future. The buyer has the right but not the obligation to take delivery of or to deliver that set number of shares at or before the contract expires at a fixed price and regardless of where the share price is trading at the time the option is exercised. The buyer pays the seller a premium for the right to buy or sell at this fixed price at a later date. We'll return to buying and selling rights very shortly. In exchange for taking in the premium, the option seller has the obligation to deliver or take delivery of those shares at that fixed price if the buyer exercises his right to call away the shares or put the shares to the seller. The buyer's risk is limited to the cost of owning the contract. The buyer pays that fixed cost and has the right to exercise the contract by or at expiration under specific circumstances. We'll come to a clear example in a moment. But the risk to a seller can be substantial. An option seller may be taking in a relatively small premium and agreeing to act as either the buyer or seller to the owner of the option contract. If the contract owner proves correct and has locked in at a better price to buy or sell, it may cost the option seller more in the open market to fulfill his obligation to sell shares to the contract owner unless the seller holds the shares. An unhedged seller of call options could feasibly face unlimited losses. For that reason, options trading is not suitable for all investors. More on what hedging is at a later point. While an option contract can be bought or sold, there are two types of options. Call options give the buyer the right to buy shares at a fixed price. A seller of call options expects the share price to remain below a specific price through an agreed upon date and time and accepts a premium for bearing the risk that it does not. Put options give the buyer that right to sell shares at a fixed price. A seller of put options expects the share price to remain above a specific price through an agreed upon date and time and accepts a premium for bearing the risk that it does not. Let's look at TWS Mosaic and think about the basic concept of options, and then we'll look at a quote monitor for option prices. We can do that by looking to the right of the order entry panel and selecting from the drop-down menu, Option Chain. You can learn quite a bit about the key concepts of options by studying this panel. Notice down the middle of the panel is a color-coded area displaying the strike prices. Remember, we mentioned earlier the agreed-upon fixed levels for option contracts. These are known as the strike prices and can be compared to the underlying price of the shares we are looking at. To the left are premiums or quotes for call options, contracts to buy a fixed amount of shares at that strike price. To the right of the panel are quotes for put options, contracts to sell shares at a fixed price. We also noted that each contract has a specific lifetime. These expiration dates are displayed as tabs above the series of strike prices. Click on a different tab to display quotes for each expiration and then refer to different strike prices to see how the quotes differ. If you'd rather see a long list of quotes by expiration date, click on the tabbed drop-down and select List View. If you compare prices of two identical call options with different expiration dates, you might quickly notice that the contract with the longest life is more expensive. Simply, that is because the greater length of time increases the likelihood that the underlying share price could reach the strike price by expiration. You can see that a 1-month contract generally costs less than a 2-month contract for call options. To see more or fewer strike prices, select from the Strike drop-down menu. To the upper right is the trading class for the stock's options and the multiplier. The multiplier tells us how many shares each option contract covers. For most US stocks, a single option covers 100 shares. You will also notice that call options at the same expiration date with lower strike prices are more expensive than calls at higher strike prices. Call options with strike prices below the current trading price of the shares are said to be in the money. If they could be exercised today, they would have intrinsic value and are more valuable than call options with higher strike prices. Call options whose strike prices are above the current price of the underlying shares are said to be out the money and would have no value if exercised now. The relationship for put options runs the opposite way. Higher strike put options are more expensive than those at lower strikes. Put options with strike prices above the current share price are said to be in the money and would have intrinsic value if exercised today. Conversely, put options with strikes below the current share price are said to be out the money and would have no value if exercised now. In the upper left corner of the options chain window is the ticker symbol we have selected. Enter a different ticker or select from prior tickers selected using the drop-down arrow. If you look across to the right, you will see the live quote, dollar and percent change on the session and a series of configuration icons. If you ever get lost with this panel, click on the question mark symbol to boot up the cheat sheet. Use the color chain to group windows together. Use the push pin to keep the window on top of others. Remember that you could unlock the layout and add this panel permanently if you wish. Or if you use the layout library, you could select option dedicated layouts to save permanently. The drop-down arrow allows users to minimize all TWS windows or print-specific panels. In the upper corner are reduce, expand, and close icons. By the way, you can also access the option chain from the blue New Window button in the upper left-hand corner of Mosaic by selecting it from the Quotes menu. Let's look at the configuration wrench. Click it and you can either change the font size or else go into configuration settings. With the option chain header expanded on the left panel, you will see three selections for Settings, Hotkeys and Layout. As well as altering the font size from the Settings menu, users can show option prices in volatility terms instead of in dollars and cents. As you learn more about options, this will become more significant. Down the center of the option chain window are the strike prices. The setting menu allows users to change the color scheme between blue, gray, or autumn colors. The color gradient reflects price moves expressed in standard deviations. See that there are two selections to choose from in the drop-down menu. Click Apply to enforce changes and keep the configuration menu open. The hotkey selection allows users to assign a single keystroke to create, modify, transmit, and request order cancellations, as well as access various tools. The Layout panel allows users to configure the option chain panel with more than the default settings. The left window shows current headers. The available columns are shown on the right. So, for example, if we want to display a reading for delta in the option chain window, expand and select from the Greeks menu. Click and highlight the desired column header and then click Add from the central panel to enable it in the shown columns. Notice the search box above. If you don't know where your selection might be grouped, type it here to search. Let's look for implied volatility in the search bar and add that to the layout too. When you've made your selections, click OK. The readings for delta and implied volatility are now shown in the display. Some stock prices are relatively stable over time and tend to reflect the broad path of the stock market as a whole. Others are more erratic. Measuring the standard deviation of a share price over the past several weeks will provide us with a historic reading of just how volatile a stock has been. This is an important concept because option traders need to price option premiums and need a measure of expected volatility. This reading of implied volatility is a crucial input to an option's price. All else being equal, a stock with lower implied volatility will have cheaper premiums associated with its options than a stock with higher implied volatility. You can see readings for implied volatility on many places in TWS. In the option chain panel, you can see the 30-day implied volatility reading for the stock as a whole below the trading class and multiplier. But if you glance down the column for implied volatility that we just added to the panel next to each strike price, you'll see individual volatilities by strike price. Note also that call and put volatility readings are likely to be different. If we click on a random ticker symbol, the share price will display in the chart window. You can see that its price has traded within a range over the past year, and its current trading price is displayed on the screen. We can add both historic and implied volatility readings to this chart by selecting from the Edit menu and selecting Chart Parameters. Investors may want to know whether shares have been more or less volatile than the market as a whole, whether they have been volatile recently, or where volatility readings typically trend before and after quarterly earnings. Let's ignore the reasons why, but just assume that a bullish investor expects that within 3 months, shares in this company will be trading higher. And so rather than buying shares in the company, the investor looks to the option market to speculate. You can see the list of call option premiums for the stock. This strike price is quoted at so many cents for the 3-month expiration. You will see that if you look at higher strike prices for the same expiration, premiums are smaller. Remember that for call options, the further away from the strike price, the lower is the chance the share price will rise that far. Sellers are prepared to accept a lower premium to take on that risk. The closer the strike price is to the share price, the greater the risk, and so option sellers demand a greater premium. Click on the ask price for that call option. This causes the order entry window to populate with the option quote, but because we clicked the ask price, TWS created an order to buy. To add perspective to the meaning of the premium demanded relative to the anticipated share price by this bullish investor, locate from the blue New Window button the Strategy Performance graph located under the Option Analysis menu. Use the pushpin to keep this plot on top or expand the plot using the Maximize button to the upper right. This displays the expiration profile for the selected option. The Pnl Plot compares the profit and loss profile today to the Pnl at the expiration date of the option contract. Pnl is measured to the right, and the price of the underlying is displayed beneath the chart. Hover the cursor over either date line to view the associated Pnl labels on the x-axis. If you hold the cursor at the strike price, you can contrast the monetary impact of time on the option position. Should the share price rise to the strike price today, the profile calculates the expected premium of the option, and so you can see an associated profit relative to the current market price of the option. However, the value of the option at the strike price at expiration reflects a loss which is equal to the current price of the option. The difference between the two lines illustrates time value, or theta as it's known in Greek terms. More on the Greek values in a different chapter. The long call option will incur a loss for the investor at expiration at all prices below the strike price. The loss is equal to the premium paid for the option. This is because the investor paid a fixed premium for the option that is worthless at or below the strike price. The long call profile reaches break-even at the strike price plus the premium paid. For example, for an option with a $35 strike price and a $1 premium, the investor would break even at $36. At expiration, the investor can call shares from the option seller at that fixed price of $35 per share. If the investor paid $1 for that right, this cost plus the cost of commissions must be factored in. Beyond the strike price, you can see that the Pnl plot rises at a 45-degree slope, cutting that horizontal break-even line above the strike by the cost of the option. So, while each long call plot will look the same as this, that break-even value will change depending on the strike price, premium, and commissions paid for the option contract. Please note that for the sake of simplicity, we are not including the cost of commissions in the break-even calculation, but you should be aware that commissions are an added cost and should be considered when calculating break-even points. Additional information on commissions and fees can be found on the IB website. Let's look at the Pnl plot for a short call. Many investors sell options specifically in order to take in the premium of an option. And don't forget, you can buy back an option at any time, and so speculators might sell with the specific aim of profiting by buying back the same option at a later date. For the premium received, they risk having to deliver shares under those specific circumstances at or before the expiration date. If we click on the bid price, a sell order is generated, and the Pnl profile automatically populates the strategy performance graph. This time, the Pnl profile displays a fixed profit below the strike price. In other words, at all prices for the underlying below that strike, the seller has no obligations and gets to keep the premium paid by the buyer. If the seller has to deliver shares at any price above the strike price, losses occur. For a short call option, the break-even price to the seller is the strike price plus the premium received and the cost of commissions. So for an option with a strike price of $35 and a $1 premium, the seller starts to lose money as the share price rises above $36, and beyond that point, losses increase penny for penny with increases in the price of the underlying. A more advanced version of this performance graph is available via the Order Preview window. Use the Advanced button to generate an order preview and check the Performance Profile box to view the Margin Performance menu. Clicking this button creates the At Expiration Performance Profile. This version offers user-driven scenario analysis, allowing users to see Pnl and Greek values for a given change in the share price. Use the Date drop-down box in the upper right to select any date through expiration. Use the selector in the upper left corner to select from Pnl or any of the Greek values. Note that, at expiration, amongst the Greek values, only delta will display. So let's look at an example of a put option. An investor wishing to protect the long stock position, anticipating a temporary share price decline, might consider buying put options to protect from losses. A bearish investor might buy put options just to speculate on rising premiums for put contracts in anticipation that the premiums might rise should the price of the underlying fall. To see what the performance profile might look like in such an event, an investor could select the contract with appropriate expiration date, click on the ask price for a put option at an out-the-money strike, and examine the profile based upon those bearish assumptions. Once again, hover the mouse above either line to contrast the expected Pnl at increasingly lower prices for the shares. The investor might not want to hold the position through expiration. Rather, he might want to see the expected Pnl 10 or 20 days from today. Use the date selector to adjust the view, and once again, use the mouse to view expected profit or loss as of the new date versus that for the current date. When using Windows grouping, note that the price of the option is plotted over time. You should note that since many options typically have a short life, the best display is over a short time frame. And as they can be infrequently traded, it is best to configure the chart to display a line. Start with a 1-week time frame and then work out in time to display longer periods. Use the max line setting to get a full history. As with underlying shares, you can often get a good sense of whether the stock is in bullish or bearish mode. And while you can see the range over time for the premium of the option, remember that its price is influenced by the price of the underlying, the remaining time value, and the implied volatility, and that because we are pricing premiums, these generally decay to zero for any option that is out of the money at or near expiration. For call options, contracts with strike prices that are above the price of the stock are out of the money, and for put options, contracts with strike prices below the price of the stock are out of the money.